War headlines kept intensifying, yet equities opened with surprising composure. Investors did not ignore the risks. They simply began treating them as background volatility. Defensive hedges stayed in place, but incremental capital still leaned toward risk. The market was not calm. It was becoming familiar with discomfort. Airlines suddenly caught a bid. Forward booking optimism returned to the tape. Travel names had been heavily discounted. Short positioning began to unwind. This was not a growth revival. It was tactical relief in cyclicals. Markets showed they still respond to even small earnings visibility. Healthcare leadership showed cracks. Weight loss enthusiasm met valuation gravity. Large inflows into defensives paused. Profit-taking became visible. Investors were not abandoning the theme. They were recalibrating expectations. Narratives rarely collapse overnight. They simply lose momentum first. Treasury yields drifted lower into the decision window. Duration quietly regained demand. Equity resilience began leaning on rate sensitivity once again. Investors were not chasing risk. They were hedging policy uncertainty. Liquidity prefers clarity. Until then, it seeks shelter in time. Dip buying instincts remained intact. Small rebounds attracted disproportionate flows. The fear of missing upside outweighed fear of fresh headlines. Markets began behaving as if shocks were temporary by default. This reflex can sustain rallies, but it also compresses caution. Markets now wait for one signal, not from earnings, from policy tone. War risk pressures inflation. Slowing momentum pressures growth. Capital is balancing both fears. Risk assets hold but without conviction. The session closed higher. Clarity did not.